What's up, YouTube? I'm Isaiah Payne. I'm a North American middle market investment banker. I work with companies doing anywhere between 10 to $1 billion in annualized revenue in the North American middle market. What a lot of people don't know is that the average investment banker actually makes his living in the middle market. The middle market is, I would say, in terms of the number of companies, the vast majority of companies, in the country, especially in the United States, about 99% of them actually. So a lot of transaction volume, happens there in terms of number of deals getting done. So today I'm going to be walking you guys through a discounted cash flow analysis and I'm also going to explain how and why they're used. So discounted cash flow analysis is used in order to calculate the intrinsic value of a company. Typically, you're going to take a DCF analysis, discounted cash flow analysis, DCF analysis, and you're going to overlay it with some relative valuation analysis, including the precedent transaction comps and public trading comps. So some things about the discounted cash flow analysis that should be taken into account is, one, when you're doing a DCF analysis, yes, you're looking at the intrinsic value of a company, but what does that really mean and why is it the intrinsic value of a company? It's the intrinsic value of a company because these are essentially valued as perpetuities. Perpetuities are infinite streams of cash flows. So, for example, whether it's McDonald's or Burger King or Starbucks, whatever, you're buying the cash flow. Like the brand is cool, yeah, all that stuff. But really, what you're doing is you're buying stabilized cash flow. You're saying you're taking a pile of money today, and you're saying, okay, I am going to buy this company because you can't retire on equity, but you can retire on cash flow. So what the DCF does, it's purely academic in nature, and it's our attempt to say what is all of the company's cash flows worth all the way into infinity. What is that worth today? Because you never really expect a company to stop making money because when it stops making money, it goes out of business. So what is that free cash flow worth today? Okay, so when it comes to doing a discounted cash flow analysis, there are some assumptions that are going to go into the discounted cash flow analysis. And one of those assumptions, or the two most sensitive assumptions that are going to go into it, are the long-term growth rate, which should never be greater than than a country's gross domestic product, GDP. So we have the assumption that it's 1.9%. So never make the long-term growth rate greater than 3%. 1.9% is safe. If you do make it greater than GDP, what you're then saying is you're implying that the company is going to grow basically larger and faster than the country as a whole into infinity, and that can't happen. So then there is the weighted average cost of capital. The weighted average cost of capital is a blended average of the cost of equity and the target equity capital structure. And typically the target equity capital structure is going to be some peer analysis for an optimized capital structure, because ultimately what you're saying here is that this is going to be essentially the target capital structure, in the future, because, DCF analysis, you're valuing cash flows into infinity. So what you're saying is that this company is eventually going to be at a steady state. And what is the optimized capital structure for that steady state? And what's the cost of that capital structure, right? So we take the weighted average of the target equity capital structure and debt capital structure, in addition to the after-tax cost of debt and the cost of equity using the capital asset pricing model, which is essentially the risk-free rate plus the risk-free premium times levered beta. And then you're going to take the next step, once you have your assumptions all laid out, is to calculate a company's free cash flow. So we have our inputs here. They're all blue for the sake of good financial modeling practices. And we're going to take our EBIT, which is our operating income, and you're going to the tax on EBIT, which is so we simply take the EBIT times the effective tax rate. We want that to be a negative number because it's a subtraction problem. And that gives us our net operating profit after taxes. And for the aspiring investment banking analysts out there, I went into a little more intricate detail to get to free cash flow, but this is something that you're going to see actually on the street while you're actually investment banking. You're going to, have to account for all of the changes in operating liabilities and assets in addition to operating working capital. But when you are doing your investment banking interviews, the answer to the question if the interviewer or the managing director or the vice president asks you, to run through the technicals, what's the formula for free cash flow, it's fair to say the formula for free cash flow is the net operating profit after taxes. Then you want to add back your depreciation and amortization, subtract off capital expenditure, and you're going to subtract off increasing changes in operating working capital. And I'm going to explain why here in a second. Okay, so you're going to add back depreciation and amortization. Why? Because it's a non-cash expense. Then you're going to net off your increasing changes in operating working capital. Why? Because your operating working capital is your non-cash current assets minus your non-cash current liability. Therefore, when you increase your assets, what you're doing is you're taking money out of the business. So when assets are increasing, money's leaving the business. And then again, we're going to subtract off for capital expenditure. What's capital expenditure? Capital expenditure is investing activities that the company is utilizing in order to grow. Then you're going to add your increasing changes in operating liability. And here we have our long-term operating liability, and that's going to put cash into the business. Why is that going to put cash into the business? Well, that's because when liabilities increase, what you're doing is the best way to think about it, or the easiest way to think about it, is to say, think in terms of accounts payable, right? Like if you have accrued accounts payable, what that means is that you have not paid your creditors back. And if you have not paid your creditors back, guess what? That means you're holding on to cash. You haven't paid them yet. So that improves your cash flow position. Okay. And now we arrive at free cash flow. And that's the first two steps to your discounted cash flow analysis. You want to, again, calculate the weighted average cost of capital. And then you want to, in your long-term growth rate, because those are, again, the intrinsic value of the company is going to be heavily sensitive to the changes in your WACC, in your long-term growth rate. And good practice is to create a sensitivity analysis with your WACC and your long-term growth rate to give you a nice range of what the intrinsic value can be if you adjust your cost of capital and in your long-term growth rate. Okay, so let's see here. Oh, and I forgot to mention that DCF analysis, typically it's somewhere between 5 to 10 years. We're using 5 years for the sake of this demonstration. Okay, so once we have all the free cash flow, the next thing that we want to do is calculate the terminal value. We arrive at the terminal value by taking the year end's free cash flow. Then we're going to multiply it by 1 plus the long-term growth rate, because what that's doing is we are saying that the year 5's free cash flow, we're actually going to take year 6 and all the way into infinity. And well, that's the number. We got to gross it up, right? So this actually year 6. And then we're going to present value it utilizing the difference between the WACC and the long-term growth rate. And that is going to give us our terminal value, this really big number. Okay, so the next order of business is to present value now all of the free cash flow. So that's the year count. Now we're going to present value each of the free cash flow. So we've got the free cash flow from year 1. We're going to divide it by 1 plus the weighted average cost of capital, and we're going to raise it to the term year. Okay. And that is the present value of year 1's free cash flow. I'm going to lock in the WACC, and I'm going to bring that over. Okay, there we go. Check our formula, make sure it's straight. Yes, it is. Okay. Our next step is to sum all of the present value of the free cash flow in our projected years. So that's 1 through 5. Then we're going to present value the terminal value, and that is the present value of the terminal value is 1 plus the WACC. Terminal value divided by 1 plus WACC raised to the term year. Okay. Then we're going to sum those two things together, and that gives us our enterprise value. And then we can also back into our implied EBITDA multiple by taking the enterprise value and dividing it by EBITDA. So it would be EBIT plus depreciation and amortization. EBIT being earnings before interest and taxes. And EBITDA stands for earnings before interest, taxes, depreciation, and amortization. So that's our implied multiple. And then we could also back into our implied share price by taking our diluted number of shares outstanding. Let's say that this is implied share price. So let's just say that, we got 1,000 shares here, or 1 million shares, and this is 7.4 million. Well, then that would mean that each share is then $7.40. That's how much the share price would then be. And that is a discounted cash flow analysis using the Gordon growth method. Again, just to kind of summarize what we covered, Discounted cash flow analysis is purely academic in nature. What you're doing is you're saying that businesses are perpetuities. Perpetuities are an infinite stream of free cash flows that go on into forever, because when you invest or you buy a company, you're investing for the free cash flow. That's what you're buying. You're buying cash flow. Companies are valued at different multiples, and people are willing to pay different prices for the same dollar of earnings, because different businesses have different risk profiles associated and different costs of capital associated with different, business models and different industries. For example, a SaaS company's cash flow is a lot safer than a retail company's cash flow. So the intrinsic value of a SaaS company's cash flow is going to be worth more than the intrinsic value of the cash flow of a retail company, because the recurring nature of the revenues is going to be, a lot safer. When perpetuities get bigger, or when cash flow gets bigger, and the stream and the free cash flow is more diversified and there's less business concentration risk, then those cash flows are less risky and the perpetuity is more valuable. You don't want to do a DCF analysis on a standalone basis when you are valuing a company. You want to overlay a discounted cash flow analysis with a, precedent transactions and public comps. And it's also important to note that practitioners, investment bankers, this is the Gordon growth method. There's another method of doing a DCF analysis where you arrive at the terminal value using the EBITDA multiple. I'll do another video of the EBITDA terminal, the EBITDA multiple, method, and we can walk through that version of the DCF analysis. But typically, you want to do both and have them side by side and compare them. And you back into the implied EBITDA multiple, and then you back into the long-term growth rate, and then you cross-reference the long-term growth rate from the Gordon growth method and the implied EBITDA multiple to the EBITDA multiple DCF method. And you'd want to typically what you'd want to see is that the numbers arrive kind of in the same range. But even if you did when you're doing the a discounted cash flow analysis, another good practice is to run a sensitivity table with the WACC and the long-term growth rate in order to figure out what the range and how the sensitivity of the changing the WACC and the long-term growth rate will affect the enterprise value of the company.